My name is Sammy Fryer, licensed realtor in the state of South Carolina, and most home buyers that purchase a home are using some sort of mortgage product or a loan. About 65% of home buyers have some sort of loan. And there are essentially four basic types or foundational loan products that exist that make up the majority of those loans in that 65%. So the likelihood is that if you are purchasing a home, you will be moving through one of these channels or avenues. And so what I've done today is invited my friend and colleague, Jamie Huggins with Movement Mortgage, to share some of her expertise and lend some insight into these packages and products, just to give a general overview of what they are and how they function, what the criteria are. And also, there's a program we have in our state of South Carolina that's a great benefit to a lot of buyers that they are seizing that opportunity and taking advantage of. She's going to share a little bit about that with us as well. So, Jamie, thank you for joining us. So, can you break down the four products for us a little bit?
We have, like you said, four main products of mortgage. We've got FHA, VA, USDA, and conventional. They all have their different benefits and separate set of guidelines. FHA is more geared towards, or is more notorious for the lower down payment option and helps buyers out that have challenged credit or high debt to income ratio. Sometimes buyers who aren't very seasoned, it might be their first time, they take advantage of the FHA program just because they've never done this before and they didn't know how to prepare for their credit and they didn't know how much money to save. And this is what they have available, and this is the financial circumstances that they're in. So it's a great product for a first time home buyer. The second program I probably do most often is the VA program. We have a good bit of veterans around here, and the program is structured especially for our active duty military and veterans. It's a great program because it offers 100% financing for the purchase price with a pretty incredible rate, and also they don't have to pay mortgage insurance like the FHA program or the conventional program with less than a 20% down payment. They have a funding fee in place of the mortgage insurance, but also if you're a disabled veteran, that you can potentially be exempt from the funding fee. So that's a really great program too.
Or a Purple Heart recipient. We
Or
did a video on
Heart
that
recipient.
earlier last year.
VA is really special to me because I do have a Marine child, and he is in his 6th year in the Marine Corps. We're pretty proud of that. So he will definitely, when he comes home, take advantage of that program. We do USDA quite a bit, which is a program that is geared towards the purchase in a rural area. It's a really hard word to say, rural. Say it, rural.
I did. There's a whole segment of me trying to say rural in like a video. I can't say it. Rural.
So if you buy on the outskirts of town, you are eligible for the USDA loan, which is 100% financing again of the purchase price. The USDA has a very easily accessible map that you can type in an address to, and it'll tell you if it's in a rural
Rural.
area or not.
Rural people say rural.
Rural.
Rural. We'll put the link to that map down in the description of the video also.
It's very easy. I send it to my customers all the time because they're looking, Pamplico, Darlington, Hartsville, Timmonsville, Effingham, everything outside of the city. And I think it's really good because to me, it's promoting a larger scope of market for us. We can move our market out and have more homes available. And the people post on Facebook all the time about selling their home. And I'm like, you need to promote this product. This is huge for buyers who don't have money.
Good point.
You know, they also have a very competitive interest rate and a low guarantee fee, is what they call it. So it's a lower mortgage insurance premium than what FHA or conventional may be. Conventional is more for our seasoned buyers, the ones who've done this before, who they're moving up in a house. They've got their 20% down. They don't want to pay mortgage insurance. They've got seasoned credit, so they can afford the program that it outlines, basically. Um, that is the only program that you'll be able to get out of any type of mortgage insurance guarantee fee, funding fee thing. I do
With the 20% down payment.
with the 20% down payment.
But you don't have to have a 20% down payment to qualify for a conventional loan.
No, absolutely not. You the very minimum is 3%, but that is depending on your income. Most people have to pay 5%, but if you're a lower income family, then you can't afford the 3%.
But at that point, you'll be looking at the PMI then.
Mortgage insurance. Yeah.
We talked about highlighting the SC housing program. I know you want to share something about that.
South Carolina Housing is a program that I've been talking about and offering a lot more lately. They have two routes that you can go with South Carolina housing. You have a down payment assistance route where it will help out on the funds that you need to close, the funds at the table, but also it has such an incredible an interest rate that no other product can compare with right now.
Mm.
Sometimes these buyers who are very well qualified for a conventional loan, who have their down payment, they've saved their money, they have a great credit rating, they've done their due diligence with credit history, they can definitely afford a conventional loan. They can be afforded a conventional loan, is what I should say. But they choose rather to go with a program that has a lower interest rate so that their payment can fit into where they're comfortable in their budget. So it's a difference of sometimes 1% in interest rate. Then there's a program that offers a no down payment scenario. That's a 2% different in our current market and what it is for them.
Mm.
2% is hundreds of dollars
Yeah.
on your monthly payment. The down payment assistance could very well put that $6,000 or $7,000 in their bank for a nest egg for sick family members, out of work, needing more furniture for the new house, anything.
Yeah.
So sometimes well qualified buyers are choosing another program just because it makes more sense for them. It's more financially responsible for them.
I did an SC housing last year. I did one, and that worked out great for my buyer. That was a good opportunity for
It
me.
is,
Really helpful.
but why not go with a product that has an interest rate that's so much lower than any conventional loan that you can find right now, and let's not get the down payment assistance, because the caveat with South Carolina housing is you get a deferred and forgivable assistance, but you have to stay in the home for 15 years. So some people are like, no, 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 we
Yeah.
don't want that. We don't want to have to pay that money back because we're probably going to move in 5, 7 years. Typically, people do.
Yeah.
But some people are also like, I don't need the money, but I do want the rate. Well, there's the program for that.
Right.
We can give you currently a 5.5% interest rate with no down payment assistance. So if you sell the home in 4 years, there's nothing left to pay back. You just have to pay that 1% origination fee. But let's talk about that for a second.
Okay.
The 1% origination fee on a $200,000 house is $2,000, a little bit less with the down payment. Now, paying down a 30-year mortgage and a permanent buy down on a $200,000 mortgage, tens of thousands. Why not pay the $2,000 to get 2% lower in rate over a conventional product and having to pay $20,000 to get
Yeah.
that rate down?
Sometimes there's a negative stigma I've seen in our field with SC housing with concerns about the guidelines and like inspections, the criteria. And so those offers are seen as less attractive.
I get it. I really do. But let me ask you this. Most customers that come to you, most buyers that come to you, aren't they going to want those inspections anyways?
Yeah,
Aren't you going to typically have to clear a CL 100 anyways?
you are.
I think the stigma is that South Carolina housing, like I said, is a lesser than loan. It's a harder loan. It's for a less qualified buyer, but that's not the case. That is not the case these days. So my plea is to, for sellers and selling agents to actually take the contracts into consideration and maybe more look at the lender who pre-approved them. Because if you have a good relationship with your local lenders, then you can pick up the phone and say, "Hey,
Right.
man, you know me well. I can tell you, yes, this is a great qualifying customer."
Yeah.
It's not. It's not always because that's what they need. It's more so of what they choose.
There's a great possibility that somebody in this audience may be saying to themselves, well, I'm not planning to buy a home in the near future. And one thing that I think, and you could confirm this, that I run into is a lot of times people, when they get ready to buy a home, maybe out of necessity, like you alluded to, changing family size, something like that, they're not prepared. And so they're set back further than they wanted to be able to move forward with that purchase. What advice would you give to somebody that may say, well, I'm not looking to buy a home now, so there's nothing for me to consider? Maybe they're buying a year, 2, 3, 4, 5 years from now. What things could they do now that would be wise to put them in a better position when that time does come to secure a loan and get a home?
I would definitely say set aside a separate savings account. Make this one savings account just for future home purchase. If you have to put $5 a month in it, $10 a month, $100 a month, you wouldn't believe how much that can add up. Even those nominal amounts can add up. And then when you turn around in 2 years and you've forgotten about this one savings account that I had, and now you're like, oh, yeah, yeah, I do have those reserves. That's what I have too. That could help your approval so much more. just that little bit of reserves. Also, credit. Credit's always going to be a huge thing. You know, I have probably, I would say 50% of the buyers that come to me that have the initial phone call, they have some work to do. We have something to prepare for, whether it be credit, whether it be where my funds are sitting. Oh, my mom, she holds my funds for me. Well, funds need to be in your bank account. So there's always things that we have to prepare for, you know. Maybe um, I work part-time. Well, it's going to be very hard to qualify you for the amount that you want in values these days on a part-time income. Let's move towards getting a full-time position so we can give you 40 hours a week, you know? So those small things, but really honestly, I think the best thing that you could do for yourself is talk to a lender in advance. Even if you don't think that your purchase is going to be for another year, that lender has the opportunity to review the current credit status, review your financials, and say, okay, here's our plan. I want you to get this credit card so we can start establishing your revolving credit history. I want you to get this separate account name and you can afford to put $100 a month in there. And guess what? In a year, that's $1,200. That could be your payment and 1 month reserve there. That's going to help you out on your approval later.
So a lot of times I've found too, there's this idea that people have that they say, well, I don't want to consult a lender now because I'm not ready because then they're going to pull my credit and it's going to devastate my credit.
Not.
And yeah, what would you say to that?
It will not. The only time a credit pull from a lender, from a mortgage lender, is going to devastate your credit. It's not because the mortgage lender approved pull. It's because you have had your credit pulled by multiple sources for different things. So we've had a car loan,
Mhm.
we've had a new credit card, then we've got a personal loan. And then your lender comes back behind you and pulls for a mortgage loan. That's when it could be a little more. One mortgage pull might hurt you 1 or 2 points, maybe,
Yeah,
maybe. But the only time it's going to hurt you dramatically is if you've had multiple sources pull your credit for different reasons.
right.
So that looks like you're just having everybody pull your credit, and that kind of gets
Yeah.
a little sketchy.
I just wanted to clear that up because I know that's a stigma a lot of people have. All right, so I know that's a lot of information in a short period of time, but you don't want to watch a 4-hour video about mortgage loans. So hopefully you find that helpful. What I will say, I say this all the time, and there could be people in this audience watching this video from anywhere in the country. So this is not just bias for us here. You need to consult a local lender if you're going to purchase a home. And so, like Jamie just said, even if you're not purchasing for maybe a year or two from now, it may be a good idea to go ahead and reach out to a local lender now. And it would be a whole separate video to get into the whys of getting a local lender is a good idea instead of going with somebody out of your market. And perhaps we'll do that in the future. But just take my word for it. Just trust my wisdom on this, please. Consult a local lender in your local market. It's going to help you out a ton. With that being said, there are a lot of good qualified local lenders here in our market here in Florence, and Jamie is certainly one of those. So I will put her contact information down in the description of the video. If you need just a consultation, or if you think you're ready to purchase your next home, reach out to her again. All of her contact information is down in the description. Jamie, thank you for joining us.
Thank you.
In the meantime, y'all take care, and God willing, we'll see you on a future video.